The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The AI trade makes NVIDIA the first $5 trillion company in two-year Treasury yields, getting their biggest bump higher in just about 4 months. 10 minutes until the closing bells here in New York, with an eye on tech earnings up ahead and a look back at the Fed meeting, Katie, that just was here. A 10-2 vote by the FOMC to cut its benchmark rate a quarter point. No surprise there, but a bit of cold water from Jay Powell on the prospects for a third consecutive cut starting in December. I'm Romaine Bostick.
And I'm Katie Greifeld.
And here is Jay Powell and what he had to say.
We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. For some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether, in fact, the growth, that the stronger growth that we're seeing is real.
Not a foregone conclusion for that December cut, and you can see the market reaction really playing out mostly in the bond market. We saw the S&P 500 dip by as much as 0.6%. It has come back, though, to unchanged territory. Big tech powering ahead with NVIDIA, of course, in charge. But then you take a look at that two-year yield, higher by 11 basis points right now. Remember, it was pretty much a lock that we were going to see another 25 basis point cut in December. That is not the case right now. That is the biggest move higher for your two-year Treasury since the summer. And you can see also that the small caps taking a hit as a result, Romaine. The Russell 2000 down now by 1%.
Ken Shinoda, DoubleLine Capital Portfolio Manager, joins us right now as we kick you off to the close. And Ken, a lot of talk right now about the moves in equity markets, but a big move today, a surprising move, if you will, in the Treasury space, 11 basis points higher on a two-year yield. What caught you by surprise?
Well, I think Powell put it really well. When you're driving in the fog, you might need to slow things down. And without data, they are in the fog right now. And I think that takes a potential cut, not necessarily off the table, but they're going to want to see some more data before they make their decisions.
Have you gotten any sense here, Ken, either from the statement today or the press conference, that the rate cutting cycle that everyone had pretty much priced in over the last couple of months here, that is still relatively intact?
I definitely think the rate cutting cycle is intact. It's just the speed at which they cut rates is going to be dependent upon the push and pull of inflation staying sticky and the labor market weakening. I mean, there's less people coming to the workforce, but as of now, unemployment rate's still low. And I think that's kind of holding the economy together. So they want to cut rates, but there are no race to.
No race to, especially you said that we need to see more data. The government still isn't open, so it's not like we're getting that official government data that might inform the path forward and might clear up some of that fog, Ken. I do want to talk about how you bring that into the portfolio. As Romaine mentioned, you saw that big pop up in short end yields. And when you think about the curve overall, does this change your thinking?
No, we've been negative on the long end of the curve. We've viewed that fiscal risks, too much deficit spending could potentially hurt the long end of the curve. We're definitely more constructive on the front end, and even more so now with this rate move. I think it's given investors an opportunity to buy, some credit assets at the short end of the curve that have attractive carry and don't have to carry too much interest rate risk. So, I think maybe a buying opportunity on that front end of the curve.
And so we're talking about duration. Let's talk a little bit about credit risk here and go to the credit market, because you write in your notes, actually, that when you take a look at both investment grade and high yield, both of those asset classes, they're behaving more like the equity market right now. Ken, what exactly does that mean?
Well, they're definitely more correlated with the stock market. When stocks are doing well, credit spreads are usually come in, and credit spreads have come in a lot. Investment grade corporate bonds and high yield have had some great performance. Investment grade spreads are near, decade-long tights, even high yields in that same space. But I think the risks are a little bit lower in those two particular parts of the corporate credit markets. Where you're starting to see some signs of trouble in the last couple of weeks has been in bank loans, and we think pockets of the private credit markets where more of the risky borrowers have gone to over the last couple of years.
I am curious on that. I mean, Powell was asked about that, at least publicly. He does not seem to be concerned. And of course, we've asked pretty much every guest about this over the last few weeks, Ken. Is there a sense here that if there is indeed some material risk bubbling up, is that going to be confined? Or do we need to start talking about this idea of systemic risk contagion?
No, I think when people talk about systemic risk, I think about the banking system. And I think the banking system has done a good job cleaning itself up for the last 10, 15 years post-GFC. And then it's in a good spot. You could actually argue that they should be more aggressive in expanding balance sheets to help the economy go along. So I think a lot of this stuff's kind of moved off balance sheet. A lot of the risks are off balance sheet and in private pools of capital. So I don't think it's a systemic risk, but there's going to be a default cycle. I mean, there's borrowers that are going to default. Doesn't mean that there's, a million cockroaches out there. Everyone seems to be talking their own book these days with these cockroach analogies. But, I think just investors should tread cautiously, know that there is risk in, below investment grade credit and allocate appropriately.
Well, it does seem like the war of words when it comes to the big banks versus what private credit firms are saying certainly continues, Ken. But to your point that we're going to see a default cycle, it sounds like you're preaching quality here, that you're not reaching down the risk spectrum necessarily.
With spreads as tight as they are and the credit curve so flat, meaning you don't get paid as much to take additional risk, we definitely like going to higher quality parts of the market. Agency mortgage-backed securities, they've done well recently, but, they're government guaranteed, quasi-government guaranteed, and they can give you some interesting downside protection. So we think you should look to kind of diversify away from corporate credit into other parts of the bond market.
I am curious, Ken, before we let you go, I just want to get your thoughts here on, I guess, what is effectively the end of quantitative tightening. I mean, assuming they don't restart it up again here. Does that actually matter to you?
No, I think that they're doing that because it's, if they're lowering rates, ending QT is just another way to ease policy. You're also starting to see a little bit of stress in the repo market, so I think they want to battle that. It's not really going to change much for investors in mortgage-backed securities. On the margin, they're going to take the dollars that are coming back from their MBS book. They're going to recycle that into short-term treasuries. So I think it's kind of a minor event for the bond markets that I traffic in, and I think it's a good thing for those short-term repo markets.
Ken Shinoda, portfolio manager over at DoubleLine Capital, helping us count you down to the closing bells on the heels of that Fed meeting. But Katie Greifeld, all eyes right now, looking ahead to a slew of earnings coming out in a matter of moments.
It's just why you think about how much we're packing into this afternoon. Of course, we'll see what the after hours trade is right now, because again, equities fighting back to go green.
Absolutely. Microsoft, Starbucks, Alphabet, Meta, MGM, just a few of the names set to report after the bells here as the S&P straddles the line between gains and losses. The NASDAQ firmly in the green, a mixed bag as the market awaits. Wait no longer. The simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell with the global simulcast. Carol Masser, Tim Stenovic, they're in the radio booth. Welcome to our audiences across all of our Bloomberg platforms here on a very busy afternoon. A lot of things going on there, a potential détente in the U.S.-China trade wars, a Fed meeting that actually surprised in a rare sort of move, and of course, a slew of earnings on tap just moments away.
Yeah, what an exciting day. And we've definitely seen a reset when it comes to the Treasury trade with, Jay Powell talking about the December meeting. So much was expected in terms of another rate cut come December. Angelo Zena was just on with us. CFRA Research covers the big tech names. He says it's a great place for big tech. Even with what we got from the Fed today, he's not worried about the environment. He said there's challenges outside of big tech, and even addressed what Jay Powell was asked about in terms of the AI spend. And again, he agreed with what Jay Powell said. This area, higher rates or lower rates or whatever, not a problem.
He's also saying, hey, NVIDIA's pretty reasonably valued at $5 trillion. NVIDIA hitting a $5 trillion market cap for the first time today, of course, but...
Yeah, I was going to say, did he exactly say that?
He did say that.
Yeah,
yes.
He did. Still a deal.
He's blown away by the number we got from the GTC event. In
500 billion.
Yeah. So.
Yeah, there you have it.
I thought it was interesting, too. He said that, this AI spend, it's not like the 1990s tech bubble because these companies have earnings. So we should point out some of these companies have earnings. Of course, there's a lot of players in this space here that have not shown a whole lot of anything. We are going to see some of those cards put on the table in just a matter of moments. We're expecting earnings out of Meta, out of Microsoft, out of Alphabet, and that's just in the tech space. Also expecting Carvana, Starbucks, Chipotle, and a few others. As we get the closing bells here in New York, the S&P straddling the line between gains and losses. I'm just going to call it right now, unchanged on the day, but it does look like it could potentially, maybe, finish in the green or maybe not. The Dow Jones Industrial Average is decidedly down more than 70 points or 0.1%. The Nasdaq is going to finish firmly in the green, up about 130 points or 0.6%. The S&P 500, we'll call it now, it is going to end the day in the red, so no record high for that. And the Russell 2000 down another day, 0.9%.
Yeah. Looking at the S&P 500, most names in that index, folks, lower today. 378 losing some ground today, Katie. 124 to the upside and one unchanged.
Yeah, super narrow there. Let's take a look at the sector and let's take a look at the circle and see what our friend is saying there. You can see that tech did manage to finish in the green. Actually, as a sector overall, up by about 1%. All eyes on NVIDIA. Communication services, which is pretty much tech in disguise, also rallying strong today. Energy industrials catching a little bit of a bid. What didn't do too well, you would guess this would be the case. Real estate down by 2.7%. We saw a big pop in yields as Jerome Powell was speaking, and that certainly hit that sector pretty hard.
All right, real quickly, NVIDIA, got to mention, $5 trillion market cap today. The stock up as much as 5.5% earlier in the day, still finishing with a gain of about 3%. Historic $5 trillion market cap. We know we got a lot of big headlines from the company and its CEO, Jensen, yesterday. Just the AI spend, the AI frenzy. And we know how important this name is certainly to the bull market that we've seen. With a 50% gain this year through yesterday's close, the stock is single-handedly responsible for nearly a fifth of the S&P 500's index, 70% advance this year. So we know it's been really driving the trade. Teradyne, just got to mention, this was definitely a top gainer in the S&P 500, up 20% in today's session. I believe it's a record close. It's a semi-manufacturing company. Third quarter results beat expectations, and it gave an outlook well ahead of analyst consensus. It also named Michelle Turner its chief financial officer effective November 3rd. That stock up 40%. And Caterpillar up 11%, also now performer today.
Is this an AI play now, I'm told? Is Caterpillar an AI play?
No, isn't it nice? We got Alphabet. Let's go
All right.
there.
Well, speaking of AI, yeah, Alphabet earnings are out. EPS coming in. Looks like a pretty big beat. $2.87 a share for the most recent quarter. The street was looking for $2.26. Revenue in the most recent quarter also a beat. $102 billion in change. The street on average was looking for roughly about $99.9 billion. The company also says that it ended the quarter, that Google Cloud, I should say, ended the quarter, get this, guys, $155 billion backlog.
Oof, yeah, certainly raises the stakes, too, for Amazon. A lot of focus on that cloud business. You can see Alphabet shares deciding what to do, moving higher right now. I will say, Tim, that the bar was high for Alphabet specifically. You think about where the stock has gone year to date, up by 45%, but clearly you can see investors parsing through and deciding what to do.
Yeah, bouncing around a little bit, but firmly higher now, about 3%. Sundar Pichai, the CEO, out saying that the company had a terrific quarter, double-digit growth across every major part of the business, calling out the first ever $100 billion quarter. He also called out Gemini. It now processes 7 billion tokens per minute and alludes to the full stack approach to AI at Google that's delivering strong momentum, shipping at speed, including the global rollout of AI overviews in AI mode in search in record time. Shares now up by about, 4%.
All right, from one hyperscaler to another we go. Let's go to Microsoft, folks, just crossing with its numbers. First quarter intelligence cloud revenue, this is what we care about, $30.9 billion. The estimate on the street was $18 billion, so it looks like it's coming in line. First quarter Azure also important. Another cloud revenue, X currency, up 39%. That beats the estimate of a gain of about 37.1%. And first quarter revenue, again a beat, $77.67 billion. The estimate on the street remained $75.55 billion, and yet we're seeing the stock down about 4% here in the aftermarket. So we'll look for some more color on this one.
Yeah, some of these numbers, while certainly a beat with regards to the average of analyst estimates that were public, it looks like they did come in below some of the whisper estimates that Bloomberg had reported on. But it gets to this idea as well, and we always have to wait with Microsoft to actually get any sort of forward guidance a little bit later. But this idea of exactly what is in the pipeline that they can actually sort of deliver or at least flag to investors that could sort of be a signal here that not just the spend on Microsoft's part, but more importantly, the reciprocity is actually still there.
Yeah, absolutely. Maybe we'll get some more detail about the pipeline when it comes to the earnings call. But you can see, again, those shares holding the after-hours decline of about 4%. And we know it was a big week for Microsoft with that OpenAI restructuring. Microsoft, of course, securing a stake here when it comes to the future, at least through 2032, Tim.
All right, I'm taking a look at Starbucks, ticker SBUX. That company out with earnings as we speak. Fourth quarter China comp sales up 2%. The estimate was for 2.16%. Fourth quarter comp sales up 1%. The beat estimates of just about negative half a percentage point. Fourth quarter net revenue coming in above estimates at $9.6 billion. Fourth quarter adjusted earnings per share coming in shy of estimates at 52 cents. Fourth quarter North America comp sales, they were flat. The estimate was for a decline of half a percentage point. Fourth quarter adjusted operating margin up 9.4%. The estimate was for 10.2%, so that came in below estimates. Starbucks shares up about 1.6% now in the after hours.
All right, so let's get to Meta because we're seeing the stock drop about 3.9% here in the aftermarket. Meta, with the outlook, sees fourth quarter revenue 56 to 59 billion. The estimate on the street is 57.38 billion. Fourth quarter 2025, or fourth quarter revenue. Let me go there because we're red heading that one here at the Bloomberg. Meta seeing fourth quarter revenue 56 to 59 billion, estimate 57.38 billion. Again, the stock down about 5%. Sees fourth quarter total revenue to be in the range, again, of 56.59. I keep rereading the same ones as they come up. Looking at the past quarter, third quarter ad revenue was 50 billion. That's a beat. The street was looking for 48.59 billion. Third quarter EPS, $1.05 versus 6.3 a share. That's year over year. So we'll look for some color on that one. And then just looking at, go ahead, Roman.
I just also want to point out, too, here, just going through the release here, there does appear to be a pretty large charge that the company took in the most recent quarter. This is a non-cash income tax charge of $15.93 billion. Meta, though, does say this is a one-off event, and I just want to be very precise in the language here, and that they do still see their fourth quarter 2025 tax rate in the range of 12 to 15%, which would be in line with what the street was looking for. But that does appear to be where we're getting some of the reaction. And one of the reasons why you did see a little bit of softness in that bottom line number for the quarter that just was. Let me just dive a little bit deeper into it and try to get you some more details.
Yeah, we'll continue to follow that. But as Romain said, could explain some of the negative reaction that we're seeing right now. Meta shares now down by more than 7%. I do want to go to this line in the release. We have a lot of focus, of course, when it comes to CapEx. Meta, they expect full year 2025 total expenses to now be in the range of 116 to 118 billion. The prior outlook had been for 114 to 118 billion there. And they also say that our current expectation is that capital expenditures dollar growth will be notably larger in 2026 than in 2025. This has really been the story for a lot of these big seven names, but also for Meta particularly.
Sorry, I do want to go back to that tax issue here with Meta, and this is something that Zuckerberg and his team are going to have to address on the call. They talk about the one big beautiful bill, basically the big budget stimulus that was passed earlier this year. They did say that they expect a significant reduction in their federal cash tax payments for the rest of the year because of that bill. However, they're saying that for the quarter that just passed, they had to recognize a valuation allowance change that basically amounted to a $16 billion charge. Again, they are saying that this is a one-time charge, and then effectively they will revert back to something that actually a little bit less with regards to the effective tax rate for the current quarter, the current fourth quarter that we're in.
Yeah, the company continues on there. Romain says net income would have increased by 15.93 billion to 18.64 billion compared to the reported net income of $2.71 billion. The company also saying, Mark Zuckerberg specifically saying that leading the industry when it comes to AI glasses, which we know that, and he sees a big opportunity there. A lot of analysts see a big opportunity there. He says if we deliver even a fraction of the opportunity ahead, then the next few years will be the most exciting period in our history.
All right. Well, those are some big words, but let's tear our eyes away from Meta for just a moment and talk about eBay, also reporting earnings. Fourth quarter net revenue, that is seen between 200 $2.83 billion to $2.89 billion. The estimate had been for $2.8 billion. So a bump up of that range. Take a look at shares down almost 9% at this point, though. So certainly some disappointment coming through when it comes to eBay.
Some disappointment as well when it comes to Carvana. Those shares down 10% in the after-hours trade, with third quarter EPS coming in at $1.03 a share, revenue coming in at $5.65 billion. But here's your guidance. The company says that full-year EBITDA will be at least $2.2 billion. It had previously pretty much guided towards that. It had a range of $2 to $2.2 billion, so maybe potentially trying to nudge slightly above that with regards to expectations. We should point out, though, the company is also saying here with regards to retail unit sales, 155,941. We'll just round up to 156,000 here. Again, that did beat the average of analyst estimates, but there was a whisper number out there that was a little bit higher, maybe partly responsible for why you're seeing the shares down in the after-hours trade.
Yeah, costs and expenses too, up about 32% year over year. Kurt Wagner, though, on our live blog talking about this net income and how we see this shortage and then attributing it to this one-time tax charge. Definitely a lot of questions on what this is, because it does feel like it's come out of nowhere.
Sorry, one quick one. Chipotle crossing the wire right now. Adjusted EPS coming in line with estimates at 29 cents a share. Revenue roughly coming in line with estimates at $3 billion. Comp sales lower than estimated, coming in at 0.3%. The street was looking for a gain of about 1% here. So a little bit light with regards to comp sales growth. Also a little bit light when it comes to operating margin, 15.9%. The street was looking for 16.6.
And while we're here, let's just talk about ServiceNow really quickly. Boosting their full-year subscription revenue forecast, also beating estimates when it comes to the look-back. Subscription revenue now seen between $12.84 billion to $12.85 billion. The previous guide was for $12.78 billion to $12.8 billion. So you can see, of course, a little bit of a boost there to ServiceNow when it comes to that full-year subscription revenue. All
right, so Microsoft down 3.3%. You've got Alphabet up about 3.5%, and you've got Meta down about 5.7%. So those are big ones that we'll keep a watch on as we go into those calls with analysts and investors. Folks, that's a wrap. Across platform, radio, TV, YouTube, Bloomberg Originals, Katie and Romaine continuing there on The Close on BTV. And right here on radio, Tim and I continuing on Bloomberg Business Week Daily as we continue to digest this earnings drop on this Fed Wednesday. We'll see you again, same time, same place tomorrow.
And you see the market reaction on the shares of three of the biggest companies in the world: Meta, Microsoft, Apple, Alphabet. Meta and Microsoft moving slightly lower here in the after-hours trade. That's putting some pressure on futures coming off of a record day for the NASDAQ and an unchanged day on the S&P 500. Alphabet shares a bid of about 4% here. The numbers for the most recent quarter for all three of those companies did beat on several key metrics. A bit of a surprise for Meta with regards to a one-time tax charge that significantly reduced its bottom line. And we're still waiting to hear from Microsoft with regards to its outlook, an outlook that it typically provides on its conference call. Daniel Flax joins us right now, senior research analyst at Neuberger Berman, joining us here in Studio 2. Where do you want to start, Dan? A lot going on this afternoon.
Great to be with you, Romaine. I think what's going on here is you're seeing these companies execute on their businesses. If you look at the Google results, the silicon, the software, search, cloud, YouTube, it's continuing to reinvent itself, and I think the outlook for Google remains attractive here. Microsoft, their Azure business is continuing to perform well. When we speak to customers, they're getting a lot of value from Microsoft, and I suspect what we'll hear on the call is that they are still capacity constrained, and of course we'll get a little bit more of an outlook there. Meta, looking past that tax impact, I think that business remains healthy. They're continuing to infuse more generative AI into the experience. They're adding value to the users on one side, the advertisers on the other, and I think that sets the company up well. But these companies need to continue to invest. The environment obviously remains tricky. There's some cyclical headwinds out there, but we continue to like all three of these companies.
I do have to ask you about valuation. And actually, before we go in, I just want to put a finer point on Meta, too, because this is a one-time charge, and it's significant. We're talking about an effective tax rate in the quarter that was 87%. Typically, it's usually in the low teens, and they say it's going to drop back to that, maybe even potentially below 10% because of the tax bill. But with regards to the valuations of some of these companies, particularly the run-up that we've seen in Microsoft, and I guess you can throw Alphabet in there as well, maybe Meta is too, are you comfortable with those valuations?
We are comfortable with the valuations. What we're focused on is really trying to understand what these companies look like on the other side of this period. We're in a period where there's extraordinary innovation. The technology changes are real. They're impacting these companies and, of course, their customers. And so they're investing aggressively. And so we're trying to think through what is the free cash flow generation in 2026, 27, and 28. And the valuations, in my view, look reasonable for these names. They do need to execute. There are, of course, going to be any number of cross currents that persist here. But I think the valuations in the context of the free cash flow generation look reasonable at current levels.
Well, let's talk a little bit more about the spend and the expected spend coming from Meta. We heard, of course, in the press release that they expect the dollar value spent in 2026 to be far ahead of that of what we saw in 2025, which has already been amazing. I mean, I think back to some past problems that Meta has had when it invested aggressively in the metaverse, which we don't talk about anymore. Then we had the year of efficiency, and now here we are again, spending hundreds of billions of dollars for this build out. Investors seem to be on board so far, but what point does it just get too much?
I think what's going to matter is whether the company can continue to execute on its core digital advertising business. Reality Labs, where they're losing a lot of money, they could certainly make adjustments there if needed. But I think the market will be comfortable with this level of spending, assuming that they can transition their business, the users, the advertisers, into this next generation of experiences. If they're able to add value, I think the market will be comfortable with the spending. Now, to be clear, every single quarter, these companies need to execute and hit their numbers. And the market, as we know, can be very unforgiving. But if they're able, in the case of Meta, to lay out this trajectory of innovation on the product roadmap, change the experiences, I think the market will be OK with that.
Well, I'm glad you brought up Reality Labs. Reality Labs revenue actually came in at $470 million. That is well ahead of the estimate for $317 million. Clearly, Meta sees a big opportunity when it comes to glasses, for example, but it sounds like you're not quite on board with that.
The technology in the glasses really is going to take time to mature. The silicon, the optics, of course, you need to bring the developers. The developers really sit at the heart of what all of these companies are trying to do in terms of empowering them to write apps and give users a reason to spend time, in this case, in the metaverse. I think the metaverse is going to take quite some time. We're seeing other industry players, of course, invest there. No one wants to be left out of the next platform, and so Meta's trying to own it. In the current environment, it's of course Google and Apple that have the largest platforms.
I am curious, Dan, and when we talk about this idea of the hyperscalers, the investment they're making, and the potential long-term benefits of that. We still have to hear from a couple of other big tech companies, primarily Amazon, which also in this space. Apple is kind of a completely different story, but they report tomorrow. When you look at the AI trade overall, I mean, you go back to 3 years ago when we first kind of became aware of ChatGPT and November, December of 2022. Is there a sense now that this trade is much broader than big cap tech, or just the Mag 7 or the Mag 5, if you will?
I think it is much broader. Clearly, there's impact to a variety of industries as you build out these data centers. Power, of course, as we all appreciate, is a very big factor when planning 5, 10, 20-year projects. So that is a factor. The cooling, the cables, all of the pieces of the data center that go in, along with NVIDIA's systems, of course, which create a lot of value. And so we're looking at all of those. We remain selective when we think about these opportunities. We expect spending to continue to be relatively lumpy, and so we like the longer-term outlook, but of course appreciate that in given quarters you may have periods of deceleration. But if I look out 2 or 3 years, these technology transformations are impacting every single industry, and some of these certainly technology companies that NVIDIA, Google, Microsoft, Amazon, we'll see what they say tomorrow night, really sit at the heart of this transformation. It isn't a straight line for any of them, but if they innovate, they execute, they really help their customers push ahead, then that sets up well, I think, over time for their shareholders as well.
Well, Dan, great to get some time with you and some instant analysis. That is Daniel Flax. He is senior research analyst over at Neuberger Berman. Of course, Meta, Microsoft down after hours. A different story for Alphabet. We'll continue to follow these tech earnings, but let's talk about Airbus. Shares just barely finishing the day in the green. That's after they reported third quarter adjusted EBIT that beat estimates. But it's not all good news. The CEO also sounding the warning bell that Airbus deliveries remain very backloaded. I'm pleased to say that CEO joins us now. His name is Guillaume Faury. He is the CEO of Airbus. Guillaume, great to have you with us. Let's talk about this target. You say that you're sticking to the target to deliver 820 aircraft, that is, to customers this year. You've only delivered about 507 through September. So what gives you the confidence that you'll be able to hit those numbers come the end of 2025?
And the fact that we are fully prepared, that we're already close to end of October, and the fact that one of the reasons for being backloaded is the lack of availability of engines for our single aisle. We were with 60 gliders mid-year. We closed the third quarter being down to 32 gliders, and we think we're going to have the engines we need to deliver those planes before the end of the year. So it's indeed a lot of work in the last quarter of the year, but we think we have the ingredients. We're prepared to come close to the 820 deliveries we have guided for.
And would you say that the engines are still your biggest bottleneck at this moment? You mentioned the gliders, for example. I know you had to park some ready-made planes because of that engine issue. So is that the biggest issue, would you say, when it comes to the state of your supply chain?
The majority of what we're delivering are the A320 family aircraft. And indeed, for those aircraft, the main bottleneck is the engine availability from both CFM and Pratt. We were with a very difficult situation at mid-year. Things are improving. We think we're going to reach our numbers, as I said before, for 2025, but we will have persisting tensions on availability of engine in 26 and maybe in 27 as well.
I am curious, Guillaume. I mean, we've heard from a lot of the major airline executives that have raised some concerns here about the backlog. In addition to just the general problems in getting those engines onto those gliders, there's now, at least here in the United States, the issue of a government shutdown that, of course, effectively brings to a halt, or at least a slowdown in any sort of certification here. Have you had to address that at all so far?
Not to a major extent. We are not significantly exposed to this situation. Again, the main challenges we have are really on the delivery of aircraft, not on the certification of them. We have recently certified, last year, the XLR that's behind us, and the XLR, the A321 XLR, is a great airplane. It is now in service. That's behind us. And the next certification moving forward will be for the A350 freighter, but that's not today a short-term bottleneck. We have to start flying with the aircraft. That will be the case in 2026. So certification is for later. We plan entry into service in 2027. So we hope that in the meantime, we will be able to restart or to have appropriate and efficient certification work with the FAA. The primary certification authority is EASA, and we're currently working with EASA for preparing the certification file of the 350 freighter.
With regards to your operations here in the United States, whether it has to do with the certification, whether it has to do with the shutdown or the broader issues, what are the deliveries, the timeline for deliveries coming out of the plant in Alabama?
Well, Alabama is one of our production sites. You know that for the A320 family, we are now relying on Mobile in the US, in Alabama, in Toulouse and Hamburg in Europe, and on Tianjin in China. For Mobile, we have recently inaugurated the second final assembly line for the A320. So we are clearly ramping up proportionally more in the US than in the rest of the world. And we have an A220 final assembly line. So Mobile, Alabama will soon become the fourth largest production site of commercial aircraft in the world. And it's an Airbus site in the US. But basically, we're ramping up A320 globally towards the rate 75. And Mobile, Alabama will take its share.
And you mentioned the A220. When it comes to your production target, you actually lowered that as well. And I would love a little bit more detail on what led to that decision and when, we might see some of these supply chain challenges that you're dealing with be unsnarled when it comes specifically to that body.
Yeah, well, I'd like to highlight the fact that we are not reducing production. we are reducing the speed of ramp up on the A220. We are actually doubling production roughly within 2 years, from 24 to 26. And we have decided to go from what we were anticipating for next year, that was rate 14, to actually rate 12. So moving up from rate 6 a few years ago, to the rate 12. We are on that trajectory. Things are moving forward quite well in 2025, but rate 12 is a challenging target. We have to integrate as well the work packages from Spirit on the A220. The wings and other smaller work packages. So we have a lot on our plate. We're also introducing progressively engine improvements to improve the durability of the engine for our customers. So a lot of work on the A220, very fast and steep ramp up. And we think that's good enough in terms of quantity of work and challenges moving from 25 to 26.
I have to ask you about the defense business. Obviously, that was a bit of a boost for you in the most recent period, Guillaume. Is this a long-term story or a one-off?
It's a mid-term story for sure, maybe a long-term one as well. You know that Europe has relied on the United States for a very long time when it comes to security of Europe, and we are now in different times. Europe is really ramping up in its ability to secure itself, to defend itself, which means significant increase in defense budgets for the main countries of Europe and the NATO members in Europe. So from that perspective, it's a midterm or even long-term perspective. And on the short term, it comes with orders for more equipment, for development of new ones. And indeed, we have a tailwind when it comes to our numbers and our growth coming from defense against that backdrop.
And we should also talk about your ambitions when it comes to space as well, and to compete against Elon Musk's SpaceX. I know that you're merging some of your operation with regional peers, trying to create a regional venture. That project expected to be running in 2027, Guillaume. Would you anticipate, though, you might run into any sort of regulatory challenges here, or is 2027 looking like a firm date?
Well, we just signed the memorandum of understanding with Thales and Leonardo to create that European player that is able to, or will be able to, compete at scale on the global competitive landscape. So that's really good. We are not only willing to compete with SpaceX and Starlink. Obviously, that's a big player and a fast-moving player, but we are serving many other needs, including defense in Europe and across the world. That creates a company that has the potential to be very competitive, to serve the interest and the needs of the European players and more global players, as I said. We have to go through the regulatory process to the antitrust. That's something that is now ahead of us. Well, I think Europe has moved forward as well, understanding that it needs to be able to compete globally. Yeah. And we hope that we will be supported for what we're doing. We have to demonstrate compliance with European regulations and other regulations. We're starting that work now.
All right, Guillaume, really appreciate you taking time for us. The CEO of Airbus there, Guillaume Faury, on the heels of the earnings just out most recently, but a big focus right now on potential delivery delays. When we come back, we turn back to the big tech companies that just reported right here on The Close on Bloomberg.
Let's take a look at shares of Microsoft, of course, getting those earnings just in the last half hour. So shares down slightly, about 2%. Our next guest maintains that Microsoft is a long-term AI winner. Let's dive deeper into the report now with Rishi, Jaluria, Managing Director of Software Equity Research over at RBC Capital Markets. Good to have you with us. You think about the numbers that we got. It was a beat when it comes to total revenue, when it comes to profit per share. Also, when it comes to Azure and their cloud computing unit, posting a 39% revenue gain. The estimate had been for 37%, but shares lower right now. Make it make sense.
Yeah, absolutely. No, thanks so much for having me. Look, the short answer to this is a very fickle market we're in, right? When anything that's AI is trading at all-time highs, as Microsoft was at the close today, you just have heightened expectations. And this is, I think, a situation of the market just being a tiny bit fickle, where maybe investors, especially post the OpenAI restructuring and the $250 billion Azure deal yesterday, were looking for something more like 40% constant currency. Now, don't get me wrong, 39% constant currency Azure growth is a fantastic fantastic number, especially given the scale of numbers that we're talking about here. This is a very broad-based beat across the board. I would be surprised if the stock is still down tomorrow morning. I think it's going to come down to, what Satya and Amy have to say on the call that begins in about an hour and what the guide, especially on Azure, looks like. But just given all the moving pieces here, given AI, it really feels like this is really well set up. And if there is, in fact, a pullback tomorrow morning, we would use it as a buying opportunity.
Yeah, there you have it. For a lot of folks, 39%, you can round it up to 40. Not when you're in such rare air as we are with these valuations and these price levels. A few notes have pointed to the fact that you did have first quarter capital expenditures coming in a bit higher than expectations, coming in at $34.9 billion. That is up from $24 billion in the preceding quarter. Does that give you any pause?
No, if anything, I think the opposite would give me a little bit of pause, right? Like, I think it's been clear that Microsoft has been a lot more picky about what sort of physical infrastructure and CapEx they're willing to commit to. And I think you've seen that play out in deals that have gone to Oracle Cloud Infrastructure and Microsoft negotiating out the rights of first refusal that they had with OpenAI. And so I think they're being a lot more deliberate about having fungible architecture that can be repurposed, whether it's for training or inferencing or reasoning. And so to me, the fact that, fully burdened CapEx, including capital leases, came in above expectations is just a signal that there really isn't this slowdown in AI demand that I think everyone's waiting for, right? I mean, with valuations where they are and kind of AI expectations where they are, there are worries around that. But I think this is telling us Microsoft is still well positioned, and we know that the team is being very disciplined about their spending. So I'm not worried about the fully burdened CapEx number coming higher than expectations. They will keep spending as long as there is demand. And I think when we're in the middle of a generational technological shift, I think that's the right thing to do.
There's when we talk about, Rishi, this idea here of an AI bubble, whether this spending can continue. There's also been a lot of talk about AI kind of, sucking the air out of the room for everything else effectively out there. Is that an accurate way of looking at this, or are we seeing, I guess, more meaningful dispersion with regards to where money is being invested?
Yeah, look, no, you hit it right on the head. We've used this term, the AI crowding out effect. And the idea is, every board is focused on AI. Every company's trying to figure out their AI strategy. And so literally that has to be priorities 1, 2, and 3 is how do we, what do we figure out with AI? How do we use this to not only generate productivity improvements and cost savings, but also over time, make this a competitive advantage, generate new revenue out of this. And so we're still in the middle of just like AI is the top priority. And that's where all the time and attention is going, and so I think that's absolutely happening. It's crowding out other areas of software. Now, Microsoft is well positioned. I think they're probably one of the few companies that can benefit from AI throughout the stack, and that puts them, I think, in a very unique situation. But that is absolutely happening there. In terms of the AI bubble, look, I have no question that we are in an AI bubble when it comes to valuations and the amount of hype around it. At the same time, I would say this is society-changing technology, and even if there's a digestion period that we have to go through at some point, I believe the way that we use AI 10 years from now will be leaps and bounds beyond what even your most fervent bull, myself included, can imagine. So it's a matter of honestly timing and picking and choosing your spots at this point. And for me, I care about really durable advantages and durable ways to benefit from AI rather than where's the biggest benefit over the next 1 or 2 quarters.
As we wait for the conference call, Rishi, what do you want to hear out of the executives?
Yeah, I think I want to hear 2 things. Number one, I want to hear that they are committed to co-innovation with OpenAI. And, with the announcement yesterday, I think that seems to be indicating that to me. I think the second thing I want to see is that there is just continued AI demand throughout the stack, that it's not just at Azure, although that would obviously be great to see, a nice Azure number, and maybe you have more OpenAI in there, you have Sora 2 in there, who knows? But if we could start to see evidence that AI is benefiting them in Office, in Dynamics, at GitHub Copilot, that they're really showing ways to demonstrate AI throughout the stack, and maybe even seeing the move from pilots to actually in production. That's what I really love to hear, Satya and Amy talk about on the call in about an hour.
All right, Rishi, always appreciate you joining us. Rishi Jaluria, Managing Director of Software Equity Research over at RBC Capital Markets. As we await that call, Microsoft shares still under pressure, down about 2% in the after-hours trade. But you heard him talking about Azure, and of course, just what a behemoth that has become for Microsoft, 40% of revenue and rising. And now expectations are high as we make that transition into AI and we find out what Microsoft's role is. Our next guest had a big role in the launch of Azure several years ago. She's now a venture capitalist over at Tola Capital. Sheila Gulati joins us right now. Before founding Tola Capital, she spent over a decade at Microsoft, and now she invests across the global AI space. Great to have you here, Sheila. I do want to
Thanks for having me here.
Absolutely. I want to draw on your current investments and more importantly, I guess, your current outlook for AI. But I want you to draw a thread kind of back to kind of the evolution, not just with Azure, but really just of cloud computing overall, because it really has now basically become central to this AI theme that's playing out.
Well, cloud computing enabled this new AI revolution. And I'll tell you, for those out there, there's obviously some overpricing in the market, but I actually don't think that we're in an AI bubble from this point of view of this is a vast societal change in the way that the world will work in general. And frankly, we had the same concerns in the cloud computing era, right? We thought we were maybe doing a race to zero margin business. And when you're a company like Microsoft, you have the ability to have platform benefits, both as a great business in its own right, Azure, but then concurrent with that, the upstack functionality that Office and Office 365 and all the co-pilot success that you're seeing with Microsoft is enjoying right now, you have benefits at multiple layers of the stack. So that company will benefit tremendously. At Tola Capital, we invest in the really fast, high product velocity AI startups that are delivering incredible value to business end users.
Give me a sense, though, of what they're delivering, or I guess maybe what the potential of what they will deliver, because that's been, as you know, a big question mark right now as to where the follow-through is in this AI trade beyond just buying chips and server space.
Well, I think that people are confused about this market. And so one of the things that a lot of people will see, you see very quickly the efficiency and the automation that comes from AI. What people don't spend as much time on, which is where I think the greater innovation will lie, is this top line, how are we changing revenue? When we first launched the cloud, people were concerned that there was not going to be adoption of this new technology. Well, it turned out companies loved to focus on what their core competency was, right? They didn't have to buy their own servers and hire engineers to manage them. And it's even bigger in the new AI era. People don't completely understand the TAM in the sense that the TAM is delivering full solutions and full new ways of doing things. And that then encompasses both your old kind of IT TAM, which has been an amazing and growing TAM, but also the labor market commensurate with that. And so when you think about a new way of doing things writ large, a lot of people are not understanding how large that addressable market potential is.
And I'm curious to get your thoughts as an investor on how you're viewing some of the CapEx going into AI infrastructure, how that looks right now. Because just to read through some of the numbers, Meta now sees full-year capital expenditure between $70 billion to $72 billion. That's an increase from their previous range. Then you take a look at Microsoft, for example, their first quarter CapEx also above expectations coming in there. So I just wonder, how much weight do you put in some of the concerns that, okay, yes, maybe AI is going to change the world and how businesses function, but maybe there's a risk that we're overbuilding here?
Well, this is being driven by end user and enterprise demand in the case of Microsoft, and by individual and advertising demand in the case of Meta. So both companies are investing mightily in CapEx. Both companies are seeing incredible growth in the businesses that benefit from that, both directly in their own assets and then in the platform and ecosystem assets that they work with, that sort of ecosystem of companies that builds on top of their platforms. One other thing to note that both companies are being very, very intelligent on is they're pulling AI and therefore programmability and software down into their CapEx. So they're making their infrastructure AI intelligent and aware. Meta's making huge investments in this. And that is a way to further take your competitive advantage, which is software, AI, algorithmic understanding, and pull it down closer and closer to the physical data center assets that you're building. That's a genius strategy.
A genius strategy. That's a good place to leave it, Sheila. Great to get some time with you. That is Sheila Gulati, founder and managing director over at Tola Capital.
And as of course, Katie, we talk about these three big companies just reporting earnings right now. Just a reminder, we get two more of the Mag 7 tomorrow with Amazon and Apple, a round out of big tech, which has, of course, been the primary driver of the rally that we've seen in markets over the last 3 years. Joining us right now is Caroline Hyde. She is the co-host of Bloomberg Tech, who covers this stuff every day. Before we push ahead to tomorrow, I do just want to get your thoughts on what we learned today. I know it's kind of a grab bag in terms of what they reported and why they reported it. But the overarching story seems to be that this gigantic AI spend, hundreds of billions of dollars, which might be approaching trillions collectively, that's still intact. Is that the read?
And we reward some companies more than others. Alphabet glowing, even though it's raising its capital expenditure. Again, they only just raised it to $85 billion before. Now they're hiking it up into the $90 billion for the full year. But because they've still got really strong underlying business model, because their cloud is growing at about a 30% clip, if not more, we're managing to reward that company that perhaps has already been doing particularly well on the year. We're looking also to a Microsoft that then gets a bit beaten up, even though we are still seeing cloud that outperformed. 39% growth is more than we expected in terms of growth for Azure. But the capital expenditure once again being ramped higher. Bloomberg Intelligence thought this would happen. They saw about a 45% increase year-on-year capital expenditure increases, but maybe others hadn't quite anticipated the amount that Amy, the CFO, is going to be pushing into the capital expenditure. Because for Microsoft, the key issue has been supply, not demand. And they've been having to look to Nscale, to Nebula, some of these neo clouds to fulfill some of their contractual obligations when it comes to cloud and Azure more broadly. So it's interesting who reward. And Meta, again, we're still perhaps a little bit anxious about the amount that they're spending.
Right. Absolutely. I do want to talk about Microsoft a little bit more before we look ahead, because, again, it's been a big week for Microsoft. You think about the OpenAI news giving Microsoft that 27% stake, also that revenue share continuing here. What kind of questions do you think that they're going to face on the earnings call when it comes to just the structure of this deal?
There's going to be structure that I think also add to the mix that they had an outage on Azure as well, which we're trying to digest. So there might be some questions about how resilient is your infrastructure and what happened underlying that. But then looking at the deal with OpenAI, there was relief, wasn't there? The $4 trillion market cap came back into sight, largely because we've got that 2032 date. They're able to keep on using generative AI models, coming large language models developed by OpenAI up until 2032, even if we do get, quote unquote, artificial general intelligence. We don't know who's on that independent board, who's going to decide when they meet it, but it seems as though Microsoft's still going to be able to use those APIs. I just want to get you to push ahead real quickly, too. I mean, you talked about the Microsoft outage. I just remember it was just almost last week where we had another outage with Amazon. We're going to hear from Amazon tomorrow. What are you expecting? We are. Look, cloud growth is, again, the watchword. But when we've got 39% growth at Microsoft, when you've got one at 30% over in Alphabet, but you're only getting 18% growth in AWS, people want to know, look, are you eroding market share? How are we starting to see a pickup? And a re-increasing number of growth coming from AWS. But Amazon's still showing resilience. They're still going to be posting growth overall in terms of the bottom line of the business. How are they navigating? What is their bread and butter, which is e-commerce as well? But I think we're likely to see Amazon. Remember, this is an underperforming stock compared to others over the course of the year. 20 seconds. Apple also reports, is there an AI story or does it not matter? It's all about just iPhone sales? iPhone 17, iPhone 17 Pro, and of course the Air. How are they selling? We only got 2 weeks glimpse into that. For
Do you own all three?
No. I don't even know what. Well, not one yet. The Air is going to be my new favorite thing, I think. There you go.
Caroline Hyde, the co-host of Bloomberg Tech, a nice breakdown of the big tech earnings that we just got and a couple other big ones that we're going to get tomorrow. Meanwhile, we do want to turn back to a couple of earnings that came out in the consumer space, if you will. Chipotle reporting, cutting its outlook, I should say, for the third time so far this year on weak traffic. You see those shares down in the after-hours trade. Meanwhile, Starbucks, which has had a string of misses for the last few quarters, now apparently getting its mojo back, a little bit of positive same-store sales growth, largely on the back of a boost from international sales. Abby Roach joining us right now, senior portfolio analyst at Allspring Global Investments. And we should point out a big thread between these two companies, as, of course, the current CEO of Starbucks is the former CEO of Chipotle. But let's start with Starbucks here, Abby. I think this was what a lot of people were looking for here. How long was it going to take for Brian Niccol to at least try to show some glimmer of a return to growth? Did we get that today?
It definitely feels like we got a start to that. It was, an encouraging update from them. I think we've been waiting to hear particularly an update around North America and specifically in the U.S. And I think the results for the comps came in better than we were hoping to see. and particularly around North America and the U.S. And the first couple minutes of the call, Brian specifically called out that the U.S. comps had returned to growth in September and that continued in October as well, driven by transaction. And in conversations that we've had with the company, transaction growth for the U.S. has been one of the keys to being able to see if what they've been working through has started to take effect. So we're very encouraged to see those comments from him.
Abby, it's interesting. You think about Brian Niccol taking the helm at Starbucks. One of his initiatives was back to Starbucks, basically to make the actual stores more inviting so people spend more time there. A really interesting story on the Bloomberg terminal today, though, that you take a look at the share of visits that are longer than 10 minutes. They've actually shrunk since Niccol took the CEO job in September 2024. So this is an initiative that they've spent millions of dollars on. Given that it seems like things are returning to normal and growing here, do you think that this is something that maybe they'll put behind them?
I think it's an important metric to be able to continue to watch, and specifically the comments around the stores that they have made the improvements to specifically. I think that's really important, sort of looking at the stores as a whole and the time that's spent in the stores versus looking at those stores where they've made the improvements. I think any commentary that they are able to provide with an update on those stores specifically is going to be important because, like you said, they've made a significant investment, and we want to be able to see that customers are spending more time in those stores.
Abby, I want to get your thoughts here on Chipotle cutting its guidance once again here in 2025. The CEO saying in the statement that they saw a broad-based pullback in frequency across all income cohorts. The company also saying is still contending with higher costs for chicken and beef.
Yes, it's a bit of a challenging environment for them. And I think, we're particularly disappointed with the 3/4 of reduction to guidance. I think expectations were low coming into the print, particularly around the guidance for Q4 comps. So not surprised to see them take that down from flat to down low single digits. But it continues to be a challenging environment for the consumer. And the company has talked about continuing to see, some challenges in terms of the customer coming into the store. So we're encouraged. We think we're long-term investors, and we think this continues to be a great brand long-term, and we think that they will navigate through the price challenges that they've seen in terms of chicken and beef and other of the input costs. But still long-term, we continue to like the stock despite the near-term challenges with the consumer.
So you still like the stock, but when it comes to weak traffic, we know that they've been trying to offer more limited time menu items. They've also been boosting their advertising. It doesn't seem like any of those efforts are bearing fruit here, Abby. So what other levers does Chipotle have to pull here?
Well, we think one of the things around the limited time offerings, the LTOs, they talked about last quarter of increasing the frequency of the cadence of those offerings. We think that will be important because they've talked about seeing really great results when they reintroduce or introduce new LTOs, specifically on the protein side. So we think that will continue to help just drumming up more excitement for the offerings. They've also talked about the dips as another area to be able to increase from a ticket standpoint. So we do think those things will start to help. Yeah. What we see here is, we think, just challenged from a, broadly a consumer standpoint.
On that consumer standpoint, and maybe this is a question not only for Chipotle, but also for Starbucks itself here, and it has to do with just the state of the consumer and pricing. I know Chipotle has been a little bit more amenable to sort of finding ways to either reduce the price that they're charging the consumer or at least offer them some more incentives. Starbucks to a little bit less extent, but do you think we can see more of that?
It's a very challenging environment for these restaurants. I think you're spot on in terms of how the two different companies are approaching this. I think Chipotle has been much more cautious around the pricing. I think with Starbucks, we've seen them take different initiatives, whether it's sort of the non-dairy milk charge, removing that. So they've been kind of playing with things in different ways to be able to try to help the consumer while still trying to absorb price as much as possible, while still continuing to try to grow margin. So it's a quite difficult environment for both restaurants here.
All right, Abby, great to get some time with you on the heels of these earnings reports. That is Abby Roach. She is Senior Portfolio Analyst over at Allspring Global Investments. And make sure to tune into The Close tomorrow for an interview with the CEO of Starbucks, Brian Niccol, of course, the former CEO of Chipotle as well. But we've been hit with a tide of earnings. Let's get you a roundup of some of the most notable movers and bring in Bloomberg's Norah, Mulinda, and Bailey Lipschultz. And Norah, we'll start with you because I know you're keeping an eye on shares of eBay.
Shares of eBay are down in the after-hours trade. We're looking at shares falling more than 6%. This is after the company reported a weaker than expected profit forecast for the fourth quarter. This, of course, really underlying concerns here about the company's profitability moving forward, but also just about this holiday season that we're really entering here, which tends to be a key season here for companies like this that's an e-commerce space. So we are seeing a lot of people really concerned about the consumer here and what this means for the overall trend, especially given the fact that there's been so many price hikes here in regards to tariff hits here. So we really are seeing the street clearly looking at these results and really heavily scrutinizing it here. But what do you got your eyes on here, Bailey?
I'm watching ServiceNow up right now, 4% post-market, beating on the top line, beating on the bottom line, subscription growth continuing to play out, the company talking up the fact that they're actually now saving money thanks to artificial intelligence. That's been long part of the story that they've been pitching to investors, but that's also why the stock's down about 15% before the results this year, because a little bit of that AI fatigue, but beating expectations. Also want to call out that the company is authorizing a 5-for-1 stock split, so leaning into maybe catering to retail investors who we know have been flocking to stocks that at least have lower nominal prices, though granted that doesn't actually change the fundamentals. But also just want to call out, guys, that the fourth quarter subscription revenue guidance, 3.42 to 3.43 billion, beating estimates for 3.41 billion, though seeing a remaining performance obligation of around 23%. So a good print from ServiceNow. It'll be interesting to see how it trades throughout the rest of the week. Katie, Romaine?
All right, thanks, Bailey. We should point out ServiceNow, one of the biggest gainers on a percentage basis in the after-hours trade. Alphabet also up about 5%. Align Technology up about 16%, and to the downside, Meta leading the charge there. A big drop there of about 7%. Cleveland Cliffs down about 8%. Right now, taking a look at CVS, those shares unchanged after dropping earlier in the session on the back of its earnings. And I felt like, Katie, just a little while ago, maybe about a year ago, we were talking a lot about CEO changes at some of these big companies and the attempts to turn around these companies. You had a chance to actually sit down with the relatively new CEO over there, David Joyner. I guess he's been on the job about a year for right now. Is there some hope here for a turnaround?
Yeah, actually almost exactly a year. I believe it was the 17th of October is when he took over. And I mean, you take a look at how CVS has performed over the past year. I think it's up 90% or so in 2025.
You told me this earlier, and I thought you were lying, and I had to go check the tape. So
well, I was worried my chart was wrong because it really is quite an improvement, quite a turnaround. A lot of that has come from writing the Aetna business. So we got the results earlier this morning. They actually raised their 2025 profit guidance for a third time in less than 6 months. So clearly something is working there. They also beat on expectations. When it comes to Aetna specifically, they and other insurers, to be fair, had really struggled to price their plans properly. That's part of the reason why you saw CVS fall by 43% in 2024. But he told us that when it comes to Aetna, that the multi-year recovery is in full swing, that they've delivered at Aetna, and they continue to look into 2026 and see a path to continue to improve. So that's one of the big factors behind the incredible rally.
So I do have a question just about their retail strategy. I remember a few years ago they made this big push to sort of make their stores kind of like almost like clinics, right?
Yeah.
Like you weren't just going to come in there just to buy toiletries. You were going to get your flu shot and maybe even talked with the RN about something. Are they still doing that?
I believe so. I mean, you did see a little bit of a pullback when it comes to primary care clinics for seniors. That was Oak Street. That got a lot of attention. And it really was an impairment charge. This is a business that they had bought for $10.6 billion back in 2023 before Joyner started as CEO. So they're pulling back a little bit there. But when it comes to overall the shopping experience, when it comes to CVS, you can get your flu shot. You can also get deodorant and toothpaste theoretically, but it's behind plexiglass. I don't know if you've been in a CVS recently.
Yeah.
I did ask him about that because we heard from the CEO of Walgreens basically saying that if you lock things up, people don't buy it.
Can I just say I have a big beef with this? I was just in Duane Reade, which is basically Walgreens here in New York, because I guess I shouldn't admit this on air because my wife's watching. I wanted some gummy bears.
Oh, that's fine.
They were locked behind the cage.
You just got to punch through the glass.
So I walked out. So it's good for my diet.
Well, there you go. You are the proof in the pudding here. He did say on that point specifically that they would prefer to not have to lock items down because it does impact sales in their stores. So they're trying a variety of different models with security guards and or other ways to basically test which approach they're going to use to stop shrinkage, but also not stop people from actually buying things.
Yeah, and I mean, I'm not unsympathetic to the issues they have to deal with regards to loss, but at the same time, you want a retail experience. It's going to be inviting, and I think with the drugstores, this has been a big issue for the last few years.
Everyone just goes to Amazon.
Yeah, some people.
Some people,
Yeah.
not everyone.
Well, some of us, some of us like the physical.
Yeah.
I like to talk to people.
The experience.
Yeah.
Well, you can talk to the worker you have to pull over.
The common man.
Yeah,
You know?
that's you, man of the
common
people.
Man. All right, a great conversation Katie had a little bit earlier with the CEO of CVS, David Joyner here. As we wrap up, what I'm told is actually the busiest trading day that we've ever had, at least in terms of the breadth of companies reporting and, of course, the market cap of that here. It continues tomorrow, Katie.
Yeah,
right?
and not to mention we had a Fed decision, too.
I forgot about the Fed decision, yeah.
Wild.
And do we have a trade deal? A lot of other things we never got to talk about here. But let's push ahead here to what the markets will have their eyes on over the next 24 hours. And it does include a lot of attention on a potential trade deal, or at least a détente here in the trade tit-for-tat between the U.S. and China.
Yeah, theoretically happening at 10 p.m. tonight. Then tomorrow morning, you think about the earnings on deck: MasterCard, Roblox, Estee Lauder, Eli Lilly. That'll be interesting. Merck as well.
And then after market, more tech earnings out of Amazon, Apple. Let's throw Coinbase, Reddit, Crowdflare, and Strategy in there as well. And one thing I'm actually keeping an eye on is CoreWeave Core Scientific, a big mashup that, well, might not happen. There's a big shareholder vote on this tomorrow, and Bloomberg reporting seems to suggest it is not necessarily a slam dunk.
Yeah, absolutely. If you take a look at how things are trading, that certainly seems to be the takeaway. An interesting moment, of course, for CoreWeave, one of the hottest IPOs of the year.
Absolutely here. Thanks for joining us here on The Close. As Katie alluded to, there was a lot else going on out there today, particularly in the world of politics. Our team of Balance and Power, they join us next right here on Bloomberg.